Good afternoon, everybody. Stan and Jack here from theartofchart.net, and today we are doing a webinar, technical patterns you can profit from. And the reason for the webinar, patterns are important. If you can see a pattern on a chart, whether it be a 1-minute chart or a daily chart or a weekly chart, you can predict market direction. And I think market direction is paramount in trading. If you're on the right side of the market, even if you have a bad entry, even if you've entered early or late or whatever, if you're on the right side, you're going to make money. And I think that's the point. So we're going to talk about technical patterns. And here is our agenda for today. We're going to talk about, again, predicting market direction and also price action. And we're going to use Fibonacci sequences to help show you, how we measure patterns and what you could expect from a pattern, for example, in terms of profitability. And we'll also show you a little bit about our basic approach to risk management. And because this is a webinar and we can't talk about all patterns because it's not possible for us to do that in a 30 to 40-minute webinar, we're going to talk about 3 basic patterns that we use every single day here on the Art of Chart to help our subscribers make money. And these are some of the more profitable ones that we use a lot. And we're going to get into other patterns also later in the year, so keep our free webinars handy. And we publish a page every month that talks about that. But we're going to start with continuation patterns, trending patterns, and reversal patterns. These are the main categories of patterns that we use a lot. Triangles, first of all, extremely profitable pattern. Why? Because there's compression oriented or involved, I guess I should say, in a triangle. And from a triangle, you get big thrusts, and with big thrusts in the market, you get big profits. And I think that's the idea. So, and the other thing about a triangle is it helps you identify the terminal side of a trend. Okay, so when a trend is going to end, sometimes, not always, but sometimes you see a triangle before a trend ends. And so we look at triangles this way. There's Elliott triangles and there are classical triangles. So we'll talk about both. Trending patterns, we're going to talk about wedges and the implied price action that comes from the direction of the wedge. And we will show you a little bit about predicting the ending of the wedge and what happens after it breaks. And also reversal patterns. And we're going to focus today on double bottoms. 2 consecutive troughs or peaks, and they're usually about equal length. Sometimes the second is a slight penetration of the first, but we'll show you how to measure the reversal pattern and what sort of price action to expect from it. So that's the agenda. We encourage questions. There's a questions tab in GoToWebinar. We want you guys to post questions. We will get to questions at the end. Before I get to questions, I want to show you just a couple of things on the Art of Chart, like where to find the webinar recording, and also just a little bit about what we do here. Our markets, these are our markets, okay? Indexes, Forex, especially US dollar Forex, energies, precious metals, gold, silver, copper, and bonds. And we also do commodities, a lot of commodity trading, coffee, sugar. We're looking at wheat right now. So that's basically the markets we cover plus stocks. And so the stocks we cover, you can see them here under our subscriber content, the big 5. Okay, so we cover Apple, Amazon, Facebook, Netflix, and Tesla. And our other services here are ways of actually covering these markets. So our chart chat videos, for example, and some of you may be familiar, we do a free one every month, but this is basically 30 instruments. Our daily update video is a evening video, a morning video with charts, which are Jack's bonus charts. And we also have just a plain old-fashioned chart service for those of you who are experienced traders. So that's kind of what we do here. And to just share with you a couple of the features that you might want to pay attention to. We have a feature called the Weekly Call. And every week on the Weekly Call, we try to demonstrate here how to methodically trade futures, okay? And it's a very, very interesting post every week. And, right now, for example, we're trading gold. We're trading coffee. We just exited that trade. We're trading cocoa. And we're trading natural gas. And our track record looks like this. In the last quarter, since October, $75,000 in profit, trading only 3 contracts per instrument, 9 winners, 1 loser, and 1 draw. The Nikkei setup never happened. 78% profit, and it's all captured here on these videos. and it's all captured in writing. So if you want to learn a little bit about trading futures and how we manage a trade, for example, I would go back and read all these posts. They're it's a very, very solid introduction to trading futures, in my opinion. So that's just something for you to look at. Also, the other thing to look at on the Artic Chart blog is the free webinar tab. The reason I'm showing you this is where the recording is going to be posted. So at the bottom of this free webinar tab, you can see here are all the free webinars from January. Feel free to go look at them. But at the bottom here, you can see the one we did last week on trading futures and commodities using Fibonacci sequences, okay? And we have a large trading library with all of our videos and technical patterns you can profit from. Guess what? It's going to be posted right here, usually 1 hour after we finish. So that's the introduction to the site. Jack, anything you want to add?
Let's get going.
Okay, let's get going. I'm going to start by talking about triangles. And I want to introduce triangles, and I'm going to use a picture to do that. Pictures are worth 1,000 words. Triangles are compression patterns, and I think many of you probably are familiar with triangles as a pattern. This is showing an Elliott version of a triangle. There's ascending triangles, there are descending triangles, there are contracting or symmetrical triangles. These are the ones that people are most familiar with usually. However, this does not do triangles justice, because you don't know if you're in a triangle unless you look at RSI. And I'm going to show you an example. And here's an example, and I'm going to show you natural gas. And I'm sure, Jack, you probably remember this one, because by the end of this triangle, we were just like looking at each other saying, boy, this is getting really boring. And usually at the end of a triangle, it is kind of boring, but it's sort of the quiet before the storm, if you will. So here's a daily, and by the way, triangles are on 1-minute charts, they're on 5-minute charts, they're on daily charts, weekly charts, whatever. So here's a triangle that was from May through October, roughly speaking, in natural gas. But the thing about a triangle is this: number one, there's a huge thrust usually that comes out of a triangle. The longer it is, the bigger the thrust, okay? And it's fairly predictable. You can predict where the E wave is in an Elliott version of a triangle. The classical version's a little bit more difficult, okay? But the typical thing that you see in a triangle is this. Do you see RSI? This is an RSI 14. RSI is compressed. Okay, and I think a lot of people make mistakes because you see triangles, okay, without compression. And if you see a triangle in price without compression, it's not a triangle, guys, and it won't thrust. Okay, that's a mistake a lot of traders make. So the compression in RSI, the compression in momentum, is what enables the thrust out of a triangle. Okay, now there's a little thing right here that you won't read about in a book, and you won't hear about it from very many people. 60 to 70% of the time, you get a break of either triangle support or triangle resistance and then a back test, okay? You back test back into, sometimes into the triangle itself, okay, before you get the thrust. So you get the break, and what we say on the Artic Chart is it's, there's no, you can get in early if you want, but there's always a chance to add back. And look at this one. Daily chart, where did we back test into? Triangle support, the triangle support trend line, but also the middle daily Bollinger Band, which turned into resistance, and then off we went. So we predicted out of this triangle a 600 tick move in natural gas. Okay, that's an example. I'm trying to show you a very simple example of what you typically see, and typically what happens here is a triangle is also a termination thrust. Okay, it's the last thrust before you get a significant turn in a trend. Okay, and that's actually what's happened here. So March of 2016, we've turned. Okay, so the trend in natural gas is now up, in my opinion. So that's natural gas. I'm going to show you one other example, which is the S&P 500. Now, the S&P 500, this is a current example. It just happened. It happened this week. So if you take a look at the S&P here, you will see a triangle. Look at the compression in RSI. It's a true triangle, okay? And I get excited when I see this, because what happens from this is a thrust. So Monday, excuse me, on the daily update, what did we say? We said this is the end of the triangle, and we're expecting upside and a break of triangle resistance, and we got that break, and we're not quite at target yet. Now, the way we measure with Fibonacci's where triangle thrusts go is based on where the impulse is coming from, into the triangle. So we're coming from this X right here, okay? This is where the impulse is coming from, okay? Natural gas was a much larger impulse coming down into that triangle. That's why the thrust was so much larger, but we look at this in proportion to the X, so the W and the X creates a thrust. Okay, now the thrust measurement is 2305, and there are a few other measurements on the daily chart that I will show you that create either a 100% Fibonacci move or a 1.618 Fibonacci move. Now, because of course we have a trend line here, we're looking for this to turn here in the next couple of weeks. 2305, 2309, that's roughly the area that we're looking for, and that's a triangle. That's a triangle thrust. And by the way, this just makes another very important point about triangles. Do you see the back test into this triangle? I don't see one. Okay, and we may still see one, by the way, but what I'm trying to say is 60 to 70% of the time in patterns, they do what they're supposed to do, okay? That doesn't mean they work 100% of the time. So you still have to manage risk in a pattern, okay? So that's my message there, and that's my introduction into triangles. I have a few other ones here on the daily chart, Jack, that I will talk about later, but what I wanted to do is throw it back to you and have you show folks a little bit about classical triangles. And you have the screen.
Right, thanks, Dan. Right, can you see my screen all right?
Yep.
Now, I'm just going to use this as a practical example of a triangle from last year and how that developed. Now, this is on TNX, and that is 10-year Treasury yields. So this is basically inverted upside down against bonds. So bonds go up, TNX goes down, and vice versa. And here, this was on the 26th of August last year, and I was talking about this triangle here, which was both an Elliott wave triangle and a classical triangle. A classical triangle is one where the trend lines line up. So this is a beautiful classical triangle. You've got 1, 2, 3. You know, this is a really, really nice one. An Elliott wave one doesn't necessarily look like a triangle, but has the same effect. This one had just broken up, and this is something where I was using the character of a triangle and also looking at other potential patterns around to actually work out what might happen on TNX and do a projection. So what I was doing here was I was projecting the triangle had broken up. I was expecting a back test. So that's at that area there. Then we would see the thrust out of the triangle. Then we would see a retracement of the triangle. And then we would see another move up, which is beyond the triangle at that stage. But I'll explain why I was doing that. Now I was using various other things to calculate the price. For instance, this level here, which is 17.5, I was using as A equals C, i.e. this thrust here would be the same length as that thrust there. I also noted that there was an inverted head and shoulder. Inverted head and shoulder pattern, left shoulder there, potentially. So what I was projecting was that we would come back, start the thrust up, we'd go and complete the head on the pattern, we'd come back and form the right shoulder during that retracement, and then the IHS would play out. We were pretty bullish on TNX, therefore pretty bearish on bonds. Let's see how that played out. All right, this is the one from a week later. Now here, and obviously, you know, it hasn't followed my arrows exactly, and the arrows didn't take any account of time. But we've come back and we've got into the right area for the back test. Let's have a look a week after that. All right, at that stage, we've finished the back test. Went very slightly lower. It shouldn't go beyond this line, didn't. That's the triangle support trend line, and we are moving back up towards the 17.5 target. The following week, oh no, okay, this is from about 3 weeks later. All right, at that stage, we've gone up, we've reached this area, and remember, an IHS is, if you've got a level neckline like this, this is of course an established resistance area. So it's an obvious place to reverse anyway. So we've gone back up there, we've completed the head, we've come back down, and we have retraced the triangle thrust, and we have got to the stage where if this is an inverted head and shoulders forming, we would be reversing back up. All right, and next we've got, this is a week after that. At that stage, the IHS is now complete. So that's left shoulder, head, right shoulder. The triangle is played out by this stage, but obviously we've now got an IHS and we're expecting it to break up, and that is what happened afterwards. So this is the triangle here, this is the little IHS, this is the IHS target, and that's where TNX actually went. So it actually went up, gapped through the target, and ran on considerably further in a very, very strong move. This is what you can do with the triangle, because triangles are highly predictable in what they do. And as soon as this triangle started breaking up, I mean, it wasn't certain that it was going to follow this path, but I was just using my knowledge of how triangles worked and what other patterns might be forming in this sort of area to establish what I thought was a higher probability path, which was that one, and it delivered. Triangles are one of the best patterns, all of them, to actually make some decent money on. You have a high probability, you will generally backtest, you will then get a thrust out, you will then generally retrace that thrust, really, to a very high degree of probability, and you will often find that that is part of a larger, different pattern setup, which is delivering at the same time.
And triangles are very common. If you look at big moves, like before the euro collapsed, there was a triangle that was well over a year long. You look at, I could go back in time and just talk about natural gas or gold or oil. There are triangles everywhere, even on a 1-minute basis. So it's a very productive pattern, and learn to use it, guys. I think it's very useful. Are we ready for trending patterns, Jack? Wedges?
I think we are.
Okay.
Shall I go straight into that?
Yeah, please.
Right. Okay. Let's have a look. Now, a trending pattern is basically when you have a trend established, you are looking at a pattern which gets you from the bottom of the trend to the top of the trend. Typically speaking, this will be some kind of a channel. You've got here, you will also find that each one of these moves, these smaller moves within it, because you get back and forth obviously, these all break down into smaller patterns, and those often will break down into small patterns still, depending on what time frame you started with. Now, this is the JPY USD, so yen versus dollar. Monthly chart. I've been following this one for quite a while, and this is a chart I posted in November 2012 calling the yen short, and I was calling it short because this was the trending pattern up here, and very nice rising wedge, and the yen tends to make very nice wedges, but you can see going back, this is falling wedge, rising wedge, channel, very nice rising wedge going up here, and it had overthrown slightly here, and basically it formed, I'd drawn in a sloping head and shoulder neckline, and it just made the second break. The first break, often you need to have a reversal pattern. Sometimes one will be formed, sometimes one won't. Here, it had basically gone back in, formed the right shoulder, and when it made the second break, I was calling it short, as it was highly likely to be going down. So that is a trending pattern. And what was the next trending pattern? Well, let's have a look. Because I was looking at that again in 2015 in August. And what's happened here? This is the original rising wedge. This is that completed head and shoulders. This was the break, and that's where I was calling it short. And you can see it's formed a really, really nice falling trending pattern, which is a falling wedge. And that I was talking about this, and I was talking about a bounce, because of course one thing you can particularly get from any trending pattern, when you get near resistance, obviously you've got short opportunities. When you get near support, you've got long opportunities. But here, of course, wedges tend to compress, and on a wedge which compresses as tightly as this one, you're running out of room. If you get to an obvious support level, and we'd retraced the whole of this wedge here, we got down to this major support level here, and we were running out of wedge pretty rapidly. At this stage, you're wondering seriously, especially if you've got RSI divergence, which we had up here, you're wondering very seriously about a bounce. So I was, it was on a video, so I can't show the chart that I was doing there, but I was talking about the possibility that it would, on a breakup, that it would break up very soon, that we would be having on a possible inverted head and shoulders forming at this neckline here, because this is anything with a bounce like this sets up a level. This is a potential inverted head and shoulder level, which either is respected or it isn't. You will get a pattern forming there, or you've got a double bottom or some other. But I was talking about this as a possibility, and it was nice to line up with the Fibonacci's as well. And I was projecting a retracement, because this wedge has retraced fully. But here, really what you're looking for is a rally. You're looking for a Fibonacci retracement for, in all probability, a continuation down. Because this is a trending pattern, but it's not a reversal pattern. A reversal pattern is one where you make the move and you reverse all the way. But actually, with these, what you tend to do is because these are all part of larger patterns, generally speaking, you're making a trending move, you'll then get a reversal, you'll do a retracement, a partial retracement of the move, and then you will start the next trending move. So what I was talking about was a retracement back to the 38.2, which for a number of reasons, as well as the Fibonacci, was a very obvious level. So let's go forward to, and here's what happens. You see, it breaks up. As soon as the trend line breaks, you know you're looking for a reversal pattern. What does it do? It goes back up to the neckline, comes back, slightly lopsided, slightly oversized right shoulder. This is a nice high chest, goes up, makes the target. Where does it make a big reversal? It makes a big reversal at the 38.2% fib retracement, because a pattern like this will generally retrace to either the 38, the 50, or the 61.8. As it happens, we're thinking it might actually reverse up from here and go up to the 50, but it's a very, very nice example of Fibonacci retracement, and this is a trending pattern doing what trending patterns do. All right.
Very good.
Great. Sure.
Great.
Back to you, Steve.
Sure. I'm going to talk about a trending pattern that is also a termination pattern. It's both. Okay, and and I just want to say something, and I'm going to start first of all with just a graphic just to explain the pattern. It's called a contracting ending diagonal. Now, this is a very interesting pattern because, first of all, it looks like a wedge, doesn't it? But what actually this is a triangle, only it's an ascending triangle. Each leg, if you notice, is in 3 waves, okay? 3 wave moves all the way up into the apex here, and when it breaks down, the target of the breakdown is the origin. It's very, very predictable. So this is one of those, one of those wedge patterns, if you will, that is a trending pattern, but it is also simultaneously a termination pattern, if you can spot it, okay? And so, by the way, they're easy to spot because they're contracting in nature. So the first wave is very big. Okay, second wave is 50% back. Third wave is shorter. Fourth wave is shorter than wave 2, and the last wave is very small, shorter than the third wave. That's counter to any sort of Elliott logic, if you will, because it is a specific pattern that we look for. Now, these patterns, when you see them, and there are 2 forms of them. There's a contracting ending diagonal, and there's an expanding leading diagonal that you can also see coming off of a turn, for example, off of a trending move. Now, here is the expanding diagonal that I'm talking about. This was the high and the turn before we saw this huge decline. And this huge decline was very, very predictable. There's a post on our website from back in June of 2015. Go look at it, okay? I posted it right here after we made this turn and predicted 1820, and we hit it. Now, how did I know that? Well, right here. This is the origin of this ending diagonal. The picture I just showed you. Here's the A, B, C, D, E in a contracting fashion, right? And what was the target? The origin. The origin was 1820. We hit 1812. So that's an example of a trending pattern. This was trending for how long, guys? I mean, from October of 2014 until May of 2015. And so, and by the way, look at the other diagnostic that you have to see in a contracting diagonal, compression and RSI. Compression and RSI is a dead giveaway. So ending diagonals are a very important structure to be able to see because it turns into, if you're a swing trader especially, and even if you're trading day trading wise, you can see this on a day trading chart very easily as well. It's a really, really great pattern. So with that said, Jack, I'm going to move right into double bottoms as a reversal pattern, and I'm going to use the same chart to talk about them. Double bottoms have been around for a long time, and I'm not going to belabor the point of double bottoms here. Okay, they're pretty obvious. Like this is a double bottom right here. You can see it, right? It's a reversal pattern. Okay, here's another one. Okay, now the thing I want to show you about these are how to measure them. Okay, so here's a double bottom, and it doesn't matter, guys, if it's a 1-minute chart or a daily chart or an hourly chart. Okay. Here's how you measure them. You take a Fibonacci expansion tool, okay, like this, and you, I'll measure this one here, and you simply put up your Fibonacci expansion tool, and you look for the 200% fib. Okay, here are all my fibs that I look for when I look at an expansion, and look where it leads you to. It leads you right up into this area where the W is. Okay, so, you know, from right here, I can predict using Fibonacci's that roughly speaking, we're going to be in this area when this impulse ends. Okay, it doesn't mean necessarily that that's the end of the impulse. We may get a back test, like this is a flat that developed, and then we got another leg up. The initial impulse out of here is usually at the 200% fib. Here's another one, this double bottom here, okay, 200% fib, right to the number. By the way, Fibonacci expansions, if you don't have them on your system, you can use a Fibonacci retracement like this, okay? Just go into your Fibonacci retracement, which usually measures 0.5, 0.618, etc., and you simply add your 200% fib right here like this. Okay, that's all you have to do. You get a Fibonacci expansion, very, very useful. And Fibonacci expansions have been around for a long time, and you can use them in other types of patterns. There's a pattern here, by the way, which is a crab pattern. We'll talk about other patterns in the future, but I wanted to show you guys this because it's so damn current right now. If you're trading an index, okay, I'm looking at not this Fibonacci, but I'm looking at the 1.618, and I'm looking at it for a good reason. You'll see why in a minute. Crab patterns end, and also shark patterns end at the 1.618, which is roughly speaking at 2308. Okay, this is printing 2310. I probably missed a couple of handles here somewhere, but the fib is 2308. We're right in that zone right now, guys. So 2308 is a pretty important number. So wanted to show you just double bottoms and how to actually predict with Fibonacci's where they end. Now, the other thing I want to mention, Jack, because we said it in our opening thing, is that when you see a double bottom, how do you trade this? And I mentioned using our proprietary risk management tools. So one of our risk management tools is as follows. Double bottom, 50 back of the previous swing. What do? You exit a third. So when we exit trades, when we enter trades, the goal of entering a trade is to get into a free position as soon as you can. And I'm just going to show this because we mentioned this. So right there at the 50 back, we take a profit right there. Move our stop to even. What do? We let the trade run. What do we look for? We look for a 3 up. Okay, 3 up, 100% fib is roughly right around here. We would get out another third right there. Am I exiting too early? Maybe I am, but you know what? I don't care because I'm in the green. Okay, I have a third left. What do? I wait and I drag my stop and use whatever other logic I have as a trader. I look for a reversal pattern. Here's one right here, a little head and shoulders right here. I would exit the trade up in this area and get out of it. So I think risk management goes along with trading patterns, and this is the way that we use it. We look for 50 back of the previous impulse, free position, 3 up, get out your second, third, and then look for your exit. So guys, I think risk management is more important than identifying patterns, and I just wanted to make that point, Jack. So I'm going to throw it back to you for your take on double bottoms. And by the way, I have somebody at my front door, so I'll be right back, Jack.
Okay, all right then. Right, let's have a look at, I'm just going to continue with JPY-USD because it's a good example, and I'm showing you the trending and reversal, and basically the movement between, because the thing is you get trending pattern, you get reversal, another trending pattern, reversal, etc. I'll actually show you, I'll give you a very good illustration of how all these patterns tend to be part of larger patterns, and I'll give you a very, very good illustration of that, and the largest, one of the largest head and shoulder patterns that I've seen forming on the yen at the moment. Now here we've got the rising wedge, and that comes up here. I'm calling it short here. Why am I calling it short here? We don't have a head and shoulders yet, but we do have the second break of the trend line support, and we do have a nice looking, very nicely technical pattern here, because ideally the shoulders should be about the same height, and you can see, even though it's sloping, they are at approximately the same height. You get a spike up here to achieve it, but nonetheless, it's by the time you get down here, it's a reasonable expectation that you're actually going to finish forming the pattern and that it's going to break down. This is a pattern which is very mature. It's taken several years to form. This has been forming basically between 2005 and 2012. And it really should at that stage get back to at least this level here, the minimum retracement, even if it was going to continue up, which I didn't think it was going to. But what I was talking about was a full reversal. That's what we got. We got a bounce here. Why exactly was I thinking that this was the target? That wasn't the IHS target. The IHS target only got you back to about here. Well, there's partly that this was the Fibonacci move, a Fibonacci retracement that you would expect is in this range for a continuation, and it's also partly because of this. This is the monthly, much bigger picture. This is a chart that goes back to 1977. This is a support trend line that runs from 1985. And here, this is a very good illustration both of trending patterns and how these all tend to fit into larger patterns. This is a falling wedge. This is a rising megaphone, because basically all the trending patterns tend to be, 95% of all trends are going to be captured within a channel. That channel will be one of three kinds. It will be expanding, i.e. it will widen as it goes up. That's what I would call a megaphone. It will contract as it moves, and that's what I would call a wedge. Or it would be, actually I don't see a channel on here, but if you've got parallel lines, then you've got a channel. They're all basically three types of channel, and these are the main trending patterns, and practically all trends will be captured in one of them. This is a very useful thing to know and very useful to use. And here you've got a variety of these, and they're all forming a large rising wedge. Now, another reason I was really keen on this area as a target, and I think this might actually hold, is because once you get a breakdown, what are you looking for in a wedge? Well, you're looking for a reversal pattern, and you will often get a back test of the broken support level. And that is what we've had with this Fibonacci retracement. We've had a beautiful back test of the falling wedge support trend line. In terms of the reversal pattern, what was I looking at there? Well, we have a potential head and shoulders here. This is the potential neckline. We'd already established the level here, and by the time we come down and we're making a low near this level already, you've got a potential head and shoulders there. It's just so big that mostly people aren't going to see it. And what we've done is the ideal right shoulder high would be at 98.09. We've gone up to 100.46. We can go a bit higher, but this would be a very good right shoulder high. And we've actually come back. We're not that far away if it actually continues down and doesn't reverse back up for a retest or a higher high. Then we are looking at a head and shoulders forming next time it reaches 80, and at that stage it could break down and it could retrace. I'd use two targets for it. The full target on this particular pattern would be at 27.5, but the other one would be a full reversal of the previous trend, and that would be the main target I would be using here. A larger pattern would be forming basically using the high made here and that trend line, and we'd see what that would become. But I think this is likely to actually retrace all the way back to this low in 1982. And the reason it's going to do that, and this is what I was saying on shorting the yen, I just said there was no currency in the world which deserved to be lower than the yen. The yen was just a disaster waiting to happen. And the reason is vast amounts of government debt. Huge, makes the Greece look like amateurs. And sooner or later, this is going to catch up with them. Does that mean this head and shoulders needs to play out? No, but it means it's more likely to. And right now, it's been forming very nicely. We came down, we completed the head, and this is the really big picture I'm watching. And we're not that far away from completing the shoulder, although I think that might take another couple of years. This left shoulder here, it looks pretty small here, but actually this took 5 years to form. And it wouldn't surprise me to see this one take another 5 years to form. So this could take at least another 2 or 3 years, but that's the bigger picture on it. And on the bigger picture, it's basically a head and shoulders which will have taken about 20 years to form for a move which might take another 10. Right, are you back now?
Yeah, I'm back. Yeah, I'm
okay.
Here. Yeah.
All right. But this is a good illustration of two things, which is one, all these patterns tend to break down into smaller patterns. This is the biggest pattern. All these ones are part of this larger one. And again, you get the same patterns throughout. So we've got the little head and shoulder patterns here, and we've got this really big one here. Does it mean it's going to play out? No. But even if it doesn't play out, that tells us something. If it fails, if it breaks down, and then it fails, I haven't given this a name yet, but this very much is a setup, then if it fails and heads back, gets past the 50% fib, I'm looking at the high so far, at that stage it would have a very strong target back at the retest of this high. So even if it fails, it tells you something.
Yep.
All right, great. So I'll throw it back to you, Stan.
We have a lot of questions, so I want to try to get through them. And by the way, guys, we really appreciate the questions because we want to try to encourage interaction. So the idea here is we've taken a couple of patterns, okay, we've put them out there, and let's take a look at them. So, okay, when will this recording be available? Usually in an hour, and it'll be again available on our website on the January webinar page, which I showed you earlier. Okay, cocoa is a London thing, and if I'm in the US, is this a disadvantage? Well, the cocoa thing I showed you on the weekly call, our weekly call hold times are usually 2 weeks to over a month sometimes. Okay, so we're demonstrating how to swing trade futures. We're not day trading them, so I don't see that as a disadvantage. Okay, that's not a question we can take here. Now someone's asking our opinion of NG, Jack, which I'm going to skip that question. Do you go back to your charts and evaluate how your analysis worked? Yes, we do. We have percentages for all the patterns that we use. And Jack, do you have any comment on that in terms of going back and looking at your analysis? I think it's essential, number one. But number two, and also, by the way, there's a series of articles on our blog called Turning Around Your Trading that actually gets into that in some detail. So Jack, you have any comment on going back and looking at the analysis of these patterns?
Well, I mean, it's not just, I mean, I've been looking at long-term stuff here, but actually we record videos every day talking about moves that are likely to happen the next day or the next week, etc. And yeah, we look and see how well did we do, did it deliver, did it not deliver. Stan's got marked on his charts, you know, little markings as to whether we were right on the direction of the market and so on.
Yep.
Yes, we do.
And the other thing you guys might want to look for, and I don't think we talk enough about this, we have a bunch of patterns on our Facebook page and on our YouTube channel that show patterns and how they have been successfully executed. So you'll find them as example trades. Okay, so if you go to our website, either at the very, very top or very bottom, you can click on the YouTube sign or the Facebook sign, and there, like for example, the trade Monday on the breakout of the triangle in the S&P 500. That's up on YouTube and also up on Facebook. So, you know, it's an example setup and an example triangle showing a thrust. So that's just something for you guys to go look at. Okay, TNX looks like a leading diagonal. Jeff, that's a very good observation. And this is something I want to say. Some of these patterns you can see an inverted head and shoulder, but you could also see an expanding leading diagonal. Okay, you could, or by the way, I could also see in that pattern a crab pattern. Okay, very, very easily. So there are many, and by the way, I think, Jeff, you probably realize this too, there are patterns inside of patterns, okay, and patterns usually transform from one to another, and I think on Jack's chart you saw like a trending pattern transform into a head and shoulders, transform into another trending pattern, etc. So yeah, you could see it as a leading diagonal as well, or even a crab pattern. I think you could see them as both. Is the triangle thrust measured from the final point E or from the point A? Oh, okay, let me try to answer that question. Jack, can you throw me the screen for a sec?
Yeah, although I would just give one quick observation on mine, which is that actually the target I was using on the triangle was really just derived on what was around it. For instance, I was thinking basically three-wave move to it, then retracement and then up, and with A equals C. That was one reason why it might be 1750, as well as the fact there was a potential IHS neckline there. So actually, that was the only way I was measuring that target. But okay, throwing you back to screen.
Yeah, I think you just answered the question, Jack, and I'll show another example just to make sure it's answered. You have to look at, by the way, triangle measurements are very inaccurate. Let me just first of all say that. You have to look at the impulse. You have to look at the impulse, what's coming into the triangle. See this large impulse here coming into this triangle? Then the compression, you can expect sort of, Newton's law, you can expect an equal reaction out of the triangle. So if you measure this from here into the wave 3, okay, and by the way, you don't see the X there. There's a W here, there's an X here. From the X into 3 here, into E, and then measure the thrust, you're down in this area, okay? And so on the S&P 500, and I'll show you that one, the hourly chart, when you measure, you have to look at what's coming into the triangle. We have this move coming into the triangle, we have the wave E, and then we have the Fibonacci's up here, either the 100 or the 1.618. And there are lots of ways to measure, but you have to remember it's a triangle. So the thrust, depending upon the amount of compression, depending upon the direction, it has the potential to be huge. If you see a 6-month triangle, it ain't going to take 3 weeks for a thrust. It's going to take a lot longer. Okay, so that's just kind of how I think about it. Jack, this is a question for you. I've seen some truly beautiful rising wedges not retrace. How often does this happen?
All the time. Rising wedges are widely misunderstood. The official line on them is that actually, the target is back at the a full retracement of the wedge, and actually that isn't true. This one did. I would say no more than 1 in 4 do that. Mostly, these actually make a trend, and then you will come back, and then you will do a retracement of that wedge when it breaks down, and then you will continue. That is what happens the majority of the time. And this is why people reckon that the target is a full retracement of the wedge, and that rarely happens in my experience, and that's why this is regarded as a very unreliable pattern, because the target actually isn't what the pattern usually does, and of course, as a result, it doesn't usually get there. So that would make it unreliable, but only if you misunderstand what it is. Generally speaking, this is just a stepping stone in a trend. And actually, a good illustration of that is looking at this one here. This is a rising megaphone. Again, just like a wedge, you've then got an official target back at this level here. Did it come back? No. Did it fail? No, because you went and you did a retracement, and then the trend continued. That is what you normally happens, and that's what's going to happen here. Because what you're doing here is you've got a wedge down, you've got a Fibonacci retracement.
Tell you what, Jack, hold on 1 second. Let me throw you the screen, because I think you're saying here, and I want to make sure people understand what you're saying. So go ahead.
Sorry, I thought I had the screen. Right, this is the overall rising wedge. Here you've got a rising megaphone. The official target on this is back at the bottom here. Did it make it? No. Did it fail? No, because actually that's not the real target. It is either maybe 1 in 4 cases to go all the way back. Generally speaking, you'll just do a retracement and the trend will continue, and that's exactly what happened here. Here, you've got one where it has returned all the way, but here, this one here, this is what I would describe as a continuation trending pattern. This is basically one leg of a larger move. You are then doing the retracements here, and then you're likely to get another leg down, and that's what I would more normally expect. So when we're looking at, when I posted this morning a big rising wedge of, SPX from the 2009 low, and people are thinking, oh well, that's going to retrace all the way. No, it won't. It usually wouldn't, and in this case, it's particularly unlikely, in my view. Yep. It's most unlikely to go all the way back, and people have these are very widely misunderstood.
Yep. And Oscar, just to also add this point, I think that wedges typically turn into other wedges as well. And I think that's something else short term. If you're trading short term, you're going to see that happen more often than not. And I think the other thing we haven't really talked about with patterns is looking at RSI and looking at divergence. So very, very key in a wedge in terms of it ending and then breaking down, which is, a wedge breaks down 70% of the time, so it's not 100% tool. And I don't know of any 100% tools guys in trading. They don't exist in my opinion.
There aren't any.
Yep. Okay, nice webinar. Thank you, Jeff. Each pattern has its own fib technique. Absolutely agree. You got to learn the patterns, especially when you get into more advanced patterns like crabs and shark patterns and stuff. They all have their own separate Fibonacci technique that is necessary. We're starting with some basic ones here for everybody to just begin to see. Patterns are great, but entering setups is hard. I have this feeling that stops get hunted. Okay, Jeff, I bet money that you're a day trader, okay, because that's very true in day trading. I think if you have a bigger time frame, that is less true less often, in my opinion. I don't know, Jack, what do you think?
Yeah, I think that's absolutely right. Having said that, I mean, when you're in terms of there's no clairvoyance in patterns. Really what you're doing is you're projecting the higher probability paths in price using math. That's really all it is. There are no the way it gets to price often will be, is inherently unpredictable. You've got to have a very good strategy, even if you know where the price is going. If you're doing a strategy which has entries and stops, you need to make sure your entries are good and your stops are very carefully considered, or you can lose money even while price is heading in the direction you're expecting it to go. But we've got separate webinars where we talk about ways to manage that. But yeah, entries, very important, exits, very important. The way you're managing a trade, Stan was talking about the risk out element of a strategy where you are cutting your risk down to zero as quickly as possible and taking some profits. And sure, this means you make less at the end, but it means that your risk is always being minimized.
Yeah, I think that's it. I love trading, so you know what? I don't mind taking off a third early and put my stop to even, because the idea of trading is not to be right or have your technical analysis be right. It's about making money. So I'll take off a third and I'll get stopped out and I won't care. I'll move on to the next trade. I think that's key to trading, guys, is not being right but being focused on making money. And
actually, I'll just make one point there, Stan.
Yeah.
This is actually partially about the nature of certainty. Now, I wrote a letter to The Economist back in the 90s talking about pensions, but the point I was making in it was that all certain outcomes tend to be bad. And I used a very telling example on it. I said that who, reading this letter, could guarantee that in 24 hours they would be alive? Nobody. But I said that all they had to do was kill themselves and they could guarantee they'd be dead. It's the guaranteed outcome is always the bad one. There is no certainty in a good outcome. There is always risk.
Yep.
And what you have to do is accept that risk and manage it.
Yep, absolutely. Okay, can you talk about how you trade patterns in RSI? I think that would be a long answer, but just to talk about I tell you what, can you throw the screen back for a second, Jack?
Sure. No worries.
I'll try to do a real quick answer on that. A wedge typically will terminate with divergence. Okay, that's typically what you see. Here's a triangle pattern. Okay, look at the triangle pattern on RSI. There's a mirroring there. Okay, you break the triangle pattern on RSI, and this is the thing about RSI, guys. You break RSI before you break price. Take a look at where my vertical line is. Okay, we broke RSI right there. We are right here in price. We haven't broken the upper line yet, the upper trend line. Okay, this is something that I talk about a lot when I talk about right here, for example, is an RSI price cycle. Okay, we broke the price cycle here. We broke it here. Okay, and price continues to go up. Okay, which is a sign that we're setting up divergence. So, in a wedge, you look for divergence near the top. Okay, if you're nowhere near divergence or nowhere near the break of an RSI price cycle, guess what, guys? The wedge isn't ready to go yet. Okay, so those are just a couple of quick points. Fred, I don't think that answer it's not a complete answer. Okay, I think that would require another webinar, frankly, which I think, by the way, Fred, I know you're a subscriber. Our Trader Education Library, there are videos that talk about that, quite a few of them. So I would reference you there. As a potential subscriber, what reading would you recommend to understand your methods of analysis? Okay, Tom, I want to say the following. What I talked about on triangles, you're not going to find written in a book. Okay, these what I shared with you about the back test into the triangle and how to measure it. People traditionally measure triangles this way. They'll, the book stuff says this. You start with the W here before the triangle starts. You take an arrow, and then you measure from here to there to see what the, and I won't be able to do it. I'll just do it here just to be quick about it. But that's what the books say. Okay, so according to this measurement rule, we're done. Okay, we should decline, but I don't think we are. We're going to back test and go higher. Okay, so a lot of what we do here hasn't been written about because they're observations that we have made about patterns and how they're measured and how they work. Okay, now there are some very good books on patterns, and they're out there, and I think there are a lot of really good books on the more advanced Fibonacci patterns like crabs and shark patterns and so on and so forth, which you can look up, by the way, and they're free resources on the internet. So I don't know why you would want to read a book, but there are all kinds of resources on the internet with decent material on patterns. So
and actually, if you'd like a couple of decent books, and as Stan says, a lot of the stuff that we've talked about today is actually our own work, and our pitch isn't one I've read anywhere. But we are writing a book, and that'll be out in the future at some point. But I mean, in the interim, I have got some recommends, and if you'd like some recommends, ask me on my Twitter, which is shj, shjack, JACK, charts, CHARTS, and have a look at, go to my Twitter ID, tweet me there and ask for books, and I will give you some. I've got a couple which are very well written, and they don't have our pitch on them, but they're a good basic primer on a wide variety of this TA stuff, and patterns in particular.
And I think as a trader, the one piece of advice I would make, guys, you got to learn to make your own observations about the market and how they work and develop your own systems. I think that's key. We're out of questions, Jack, so that's a wrap.
I think it is.
All right.
Pleasure as always, mate.
All right, guys. Thanks very much for the questions. Great webinar. Everybody take care. Bye-bye.
Take care.